if you look at what's happening in the markets now, we're not in bear market territory, but the next bear market threatens to be as extensive, possibly more extensive than the previous one.
Welcome back to Breakout with Breaking Views, brought to you by PGIM. I'm Peter Thalassen, acting global editor of Breaking Views in Canary Wharf in London, in conversation with Edward Chancellor, once again in his hideaway in the British countryside. Eddie, good to see you again. This week we are talking about bear markets. Last week, actually, the S&P 500 index came within a hair's breadth of falling 20%, the traditional definition of a bear market, but there has been a bounce since then. But Eddie, you've been looking at the history of bear markets and why things might be different this time. What can you tell us?
Well, as you say, we thought about this, conceived this article when we were on the verge of a bear market. We've drawn back a bit now, but I still think it's worth thinking about the nature of bear markets. And based on my research, what you find in the US is that bear markets, these 20% drawdowns, tend to be relatively short-lived, only less than 10 months. The other thing's interesting is that over recent decades, they've become less and less frequent. There was no bear market between 1987 and 2002. There was no bear market between 2009 and the COVID crash of 2020. So there's a long periods without a 20% drawdown. So the
COVID crash was very short, right? It was just over a month or something.
Yes, and that's so the crashes of recent periods have become, they're not any more infrequent, but they're relatively short-lived. The COVID crash, I think, was the shortest bear market in history, just 33 days. The October 87 crash lasted, I think, 100 days. So, and the question is, so why have these bear markets become so infrequent, and why was the last one so brief? Well, the answer's pretty obvious, is that the Fed was there ready to support Wall Street when things were getting dire, what we call the Fed put. And the thrust of my piece is to say, well, now that inflation is here, back strongly in the UK, as you know, going above 10%, then the Fed put, or the central bank put, the capacity of the central banks to underwrite stock markets has been taken away. And I think, to my mind, that changes everything. And it means that the next bear market is likely to be different, and I'm suggesting perhaps longer and more severe than those we've experienced in the recent past.
Well, indeed, you quote an economist in your piece who makes the argument that actually this time the Fed might quite like to have a bit of a bear market because it would make it easier to control inflation.
Yes, so I mean, the Fed put is actually a Fed short now, I suppose you could say. I mean, how long that'll be, we'll see. The other thing I explore in the piece is, you know, what is the trigger for the next bear market, and what type of assets will be affected. Now, if you think back to the global financial crisis, the trigger was the subprime securitizations that sort of fed their way through the global financial system and almost blew it up. Now, to my mind, the trigger is rising interest rates, rising from levels that have never historically been seen before. And I'm just going to read you a line from Seth Klarman, who's perhaps one of the best investors in America, Boston-based hedge fund manager. And this is what Klarman wrote in a year-end letter to his clients. The idea of persistent low interest rates has wormed its way into everything. Investor thinking, market forecasts, inflation expectations, valuation models, leverage ratios, debt ratings, affordability metrics, housing prices, and corporate behavior. So we've had, as you know, in the last few years, what's been called the everything bubble. And I'm saying that if we've had an everything bubble caused by ultra low rates, then potentially everything is at risk from unexpectedly high rates. And I think we're beginning to see the blow off. We've seen, the SPACs go down. We've seen the cryptos crashing. We've seen some long dated UK linkers drop more than 40%. The NASDAQ, the growth stocks are down 25%. To my mind, these are the sort of early indications of the ructions to come, a bit like the subprime defaults feeding through in 2007 to the Bear Stearns hedge funds. Though, if you were following the story, by the summer of 2007, you thought, you should be saying to yourself, I'm afraid. And I think that if you look at what's happening in the markets now, we're not in bear market territory, but the next bear market threatens to be as extensive, possibly more extensive than the previous one, because as I mentioned in the piece, China bailed out the world economy back in 2008, but it's in a much worse condition today with too much debt and a deflating real estate market.
And with inflation sort of rampant, then I guess the comparison which you draw is the bear market of the sort of the early 1970s, which was very severe.
Yes, so I make 2 points about the bear markets of the 1970s that accompanied the Great Inflation. First of all, they lasted a lot longer, more than twice as long as the bear markets of the last 30 odd years. But more importantly, because investors who are long-term investors can sort of deal with a grin and bear through a bear market. But what's much more important is that the valuation of the stock market, the US stock market, came down immensely during that period. And I cite a piece that Warren Buffett wrote for Fortune magazine in 1977, where he says that the inflation, he says that inflation swindles investors and that it's a sort of tapeworm inside corporations, sort of consuming their returns. And at the beginning of the Great Inflation, stocks were valued on a cyclically adjusted price earnings ratio of 24 times. And at the end of the Great Inflation, they were valued on a cyclically adjusted PE of just 7 times. Well, today, the same basket of stocks is trading on more than 32 times 10 years trailing earnings. So you can see that the inflation, if it comes, it not only sort of blows up the crypto stuff, potentially, but actually, and this is much more serious for investors, it actually leads to a progressive devaluation of the market.
More potentially to come as far as this bear market is concerned. Eddie, great to talk to you again. Thank you very much, and see you again soon.
Thank you. Bye.